far as the bank nifty goes. About 2/3% each is what small caps and the mid caps are also trading at. We have Vinay Jaising, who's joining us now to chat more about markets and the way they are approaching their own portfolios. Vinay, afternoon, always good to have you on the show. Vinay, we are just starting off with the earnings season, and the early signs which have come from IT, the big flare up because the expectations themselves are very low. This is going to be a big week for earnings. About 25% of the index earnings today, this week. What are the sectors where you expect a good show, and which ones could disappoint in your view?
Thanks so much for the invite. Happy New Year to everyone. So firstly, when you look at earnings overall, we think India Inc.'s earnings, in our universe would grow between 19 and 20% on the bottom side. And on the revenue front should be about 4 to 5% and some margin growth of, somewhere close to 100 basis points. So that would be our broad indication for earnings. As far as financials is concerned, it would be business as usual, which is, superb loan book growth. Whatever numbers we've seen of loan book growth coming out so far have been between 15 and 20%, apart from maybe BOB, which was at about 13%. But great loan book growth. A little bit of cut in the costs should lead to a bottom line growth for the financials of 19 to 20%. So that's a sector which every analyst and every fund manager will keep on looking at. IT sector, no news, nothing negative coming out. Semblance of seeing that, you're seeing close to the end of pain as far as revenue growth is concerned, and new order book coming up is getting investors excited. But also remember, these are stocks which in the last 12 months have gone nowhere. So some good news of saying that, the next quarter or two, you'll start seeing revenue pick up will do well, but IT sector will not grow the revenues of the sector as far as this quarter's earnings are concerned. 0 to 3% is a best case basis in our eyes. Where we are excited about would be in CapEx and pharmaceutical space and auto space. These are the three sectors wherein we think the earnings of India Inc. or let's say the Nifty would do better than what it would do historically. So north of 20% in the auto space, even higher. In the capex space, if I take a simple average for our universe and I go above Nifty 50, we are looking at a 60% year-on-year growth. So these are spaces where we think things could be a lot more positive. But a 20% growth seems to be a given overall in most of the indices. And that would lead to analysts at least maintain, if not increase their numbers for most of the indices going ahead.
Vinay, in your own portfolio, which section of your portfolio is the highest, where it has best earning visibility and the confidence when you speak to some of the managements out there that next 2 to 3 years, that runway on growth is intact?
So again, capex and industrials, that's a space wherein we are seeing the earnings visibility being fantastic. If you look at, the railway sector, here and even after last year's earnings, which I think everybody more than doubled, we're seeing north of 70 to 80% year-on-year growth and even sequential growth of 5 to 10%. So that's railways. If you look at defense, we are looking at, because the base was lower last year, apart from maybe Hindustan Aeronautics, which would grow at 8 to 10%. The rest of the companies in defense should grow north of 25 to 30% on a year-on-year basis. Again, it was a base impact as against Hindustan Aeronautics, which has much higher profits and growing at about 8 to 10%. So that's industrials. If you look at good sectors, companies like Kirloskar Oil or water companies like Viatech Waba, again, there a healthy earnings momentum growth of 20 plus percent. Somewhere between 20 and 25% or a little higher is where we are looking at. So earnings growth in the capex sector is where we are most excited about. Where we are looking at with a magnifying glass is really in the chemical space. Some spaces, because we've seen prices move up, we would see, like in the IT sector, the pain behind us, and there we are looking more for commentary. Maybe one odd name out there would also see high earnings growth, say companies like Archean Chemicals.
Is valuation becoming a bit of an issue now for your stock picking process, Vinay? Because I'm sure the flows are good, and plus your existing portfolio would also be expanding due to market going higher. How are you dealing with the challenge of valuations, rising valuations?
So, as you put it, right, so valuations are close to peak for many names. People say large cap valuations are a little cheaper than what they were in the past, or on a relative basis, probably cheaper. But if I would take the Nifty 50 and take the seven large cap stocks, which grew, I would say, at much lower rates last year of 7 to 8%. Rest of the 43 stocks grew by over 30%. So valuations all over are an issue. What you need to look at is bottom up stock picking where you're comfortable in. We're still a lot more comfortable in a lot of mid and small cap names wherein we're seeing earnings visibility leading to actually earnings growth drivers. So if earlier you had an EPS of a company which was X and that's going up by 20 to 25%, your new PE may not be as high as what you're expecting. So for us, it's all about bottom up fishing and looking at stocks where valuations are not expensive. But as you rightly pointed out, I can't say that an index number is looking cheap. Today we on an index level are at an all-time high. We're trading at about 20 to 21 times. I'm more interested in bottom up stocks where we think we can see a lot more higher growth coming.
Vinay, talk to us about this point which you just made, that there is scope for outperformance in select areas where market is actually mispricing the opportunity. Which are the areas of the market, in your view, where the risk reward is very juicy even now?
So again, where you can see visibility of order book coming from domestic as compared from global, that's where we are focusing in a lot more. If you look at the budget, right, the budget as far as capex is concerned has gone up by about 5.6 times in 2023-24 as compared to 10 years ago. Our eyes would be focused on, will the capex increase by the government, and when will the corporate India start increasing as far as capex is concerned, because that's one leg we haven't seen. We haven't seen corporate India increase its capex. Maybe that will come post elections. In that space, we're seeing people move out of looking at one-time order book to going to as much as 5 to 10 times order book. Right, the defense and railway names are in the 7 to 10 times. The water treatment names are between 4 to 5 times, and even simple cap good names are between 1.5 to 2.5 times price to book. So that's where we think, the visibility of earnings are actually improving, earnings are inching up, and valuations are really not what you're seeing because you're increasing your EPS, and there are relatively safer havens.
Quick word before I let you go regarding the rate cut cycle. The sense is that the rate cuts in India may actually follow mid this year after US starts, but the rate cuts would be few and shallower. Is all of that in the price in stock markets, or eventually there would be some discounting when we actually see rate cuts happening?
So if the loan book growth is so good when the rates are so high, what's going to happen to the loan book when the rates go down by about 50 to 100 basis points? They'll probably increase further. When the moment of truth comes of actually cutting rates in the country, which may come sometime in May, June, July, in line with the rest of the world, the loan books will look a lot more pleasing in terms of growth. The capex cycle for corporate will start singing in, and that's when you'll probably see earnings lift by virtually most of the analysts for the broader space. So I think, yes, not just for India, but for the entire world, when the loan book growth, the interest rates cut down, you'll see loan books go better. And you'll start seeing overall markets look a lot more robust as well, because you'll just see earnings visibility improve.
You go on that one. Thanks so much for joining us on the show today. That was Vinay Jaising, head of PMS at JM Financials. But before we move on, I also get two big stories.